It will give you something to think about and take home. So somebody asked before my session that how many of you wish to be founders in the next 5 to 10 years? Oh, fantastic. So the point is that how will you build your own startup? We have seen so many ideas thrown up today. Okay? So a lot of knowledge was shared with you, a lot of technology was shared with you. Now let me share one very important thing with you guys. And that is money. So let's talk about money. Because it's a little bit disturbed because of, I think, the laptop change. Okay, so the topic for the day is how you will fund your startup for free, absolutely free. Can that happen? Can you bootstrap your startup for free? Is it possible? Can't think so. So let's see. Let's start with a story. A normal story of how people form their startups, okay? So the story goes like this. There are 5 friends. They graduate from an Ivy League college, or maybe Ramaiya, okay? Like all of you today, sitting here from different colleges. And you decide, you have a dream of starting something on your own, as you guys said right now. But of course in the future, right? So you all take up jobs in some good companies, and then you decide that one day we'll certainly form our own startup. People go in their own way. After 4 years, they meet somewhere. And as you can see, now they are corporates. See the difference in their, how they are cultured now. So they meet in a coffee shop. That's what we normally hear. People meet in coffee shop and they scribble something on that paper napkin. Okay? And that grows into something big one day. So these people assemble in a coffee shop. They crib about the corporate culture. And all of them decide to hang their boots and follow their dream. Finally, the time has come. So what they do? They start their own startup. So 6 months thereafter, they take up a garage space. That's what again we commonly hear in all the startup success stories. They start from a garage. They brainstorm on a few ideas. They pull in some funds. You need funds for bootstrapping your company, right? So they pull in like 48 lakhs each. So within these 4 years in the corporate life, they have earned a lot of money. So they bootstrap around 48 lakhs each. That is total of 2.5, approximately 2.4 crores. And they hire a team, a good team, technology people, marketing people, and so on and so forth. And start burning cash. That's what normally people do. A few months or maybe years later, what happens is they run out of money. So all the money that they had pooled in, and now they have left the jobs, so they're full-time into their startup, so they don't have any other source of funding. They don't have any other source of income. The money goes out. And research says that 30% startups fail just because of this one reason: they run out of money. And then they have to wind up. So what happened? If they wind up, what's the outcome? They have suffered a loss of 48 lakhs each that they had put into their startup. And not just that, they had left the job and pursued their startup dream, so they have lost their earning source as well. So if suppose this was 2 years' time, so their normal income that they would have earned in 2 years is also lost. In all, they have lost 2.5 crores. This is what we normally see. Now let's go back in time and see things differently. Let's go back in time. So again, there are 5 students. Like today, you are sitting here in this college, having a dream of starting your own startup. Okay? Let's go back there. Now what you do? You do some things differently. Okay? So the missing link is those 4 years. The 4 years when you were into your corporate life, what you should have done in those 4 years will make a lot of difference, as we'll see now. And now what they do is, they appoint me as their financial advisor. Thank you so much. So let's start the journey together again. Okay, now I am with you guys. So what we do in the next 4 years is that as you guys go into your corporate life, get a good job, okay, we define a strategy, which I call as a goal-specific investment strategy. And these things that I'm telling you today, you can apply this not just to start your startup, but to do a lot of other things in life. Like you buy a house on EMI, you buy your cars on EMIs, you do a lot of expenses out of your pocket. But I say that that is not just waste of money. When I spend, say, a lakh rupees out of my pocket to pay my EMI, I'm not losing just that 1 lakh, but I'm losing some 100 crores. And I'll prove it to you right now, how that happens. So we define a goal-specific investment strategy. What we do is, we create a fund. So there are 5 people, and there's a reason I have taken 5 friends. I'll tell you about that. So we create a specific fund and call it as in, whatever name you want to give, your startup name, XYZ or X Square, whatever name. You might not have thought about a name, just give a dummy name. So that is this, okay, fund that you create. Now, you'll invest that pool of money that you are creating every year, and you are, instead of, putting it directly in your startup, you're putting it in your investment pool. And you will invest that money into stock market, or maybe there are many other asset classes that you can use to invest your funds, which will generate an income of somewhere like 10 to 30% per annum. And since this is the goal of starting a startup, which is a risky affair, even your fund can have a little bit of risk. So you can invest your money in, say, small cap companies, and you can easily generate around 25 to 30% per annum. After 4 years, when your money has grown, we'll withdraw some part of that money and put in your startup. So now when these 4 people meet again in that coffee club and decide to hang their boots, what they have got in their hands. Let's see. So the case study is like 5 founders. They are earning salary, the corporate salary of 20 lakhs per annum, which is quite common nowadays. They invest 30% of that, that is 6 lakhs each. So into 5 is 30 lakhs, is the money that they're investing every year into this pool, into that fund, okay? And it is growing at a rate of 25% per annum. And I can show how that can happen. So in these 5 years, or rather 4 years, sorry, they have invested 1.2 CR, 6 lakhs each, into 5 people, 30 lakhs into 4, 1.2 CR. And you have got a growth of 75 lakhs on that. So your money is now growing. And this is what we call as the power of compounding. So I'll take a brief break here and tell you about power of compounding if you don't know. Mostly engineering students, they don't understand this. This is a very important thing to understand. You do hard work to earn money, right? How much hard work can you do? More and more. Can you compound your hard work? It's not possible. So your hard work gives you money to a certain extent. But your money can generate more money exponentially without you doing anything. That's called as the power of compounding. So let's take a simple example that if you're investing at 25% per annum rate of return, your money will double. So your 1 rupee will become 2 rupees in around 2.8 years. Your money becomes double in 2.8 years. Okay? So 1 becomes 2 in 2.8 years. Now in next 2.5 years, that 2 will become 4. In next 2.5 years, that 4 will become 8. So that is exponential growth. It's not like 1, 2 and 2, 3 and 3 becomes 4. No. 2 becomes 4, 4 becomes 8, 8 becomes 16, 16 becomes 32. That's compounding. So now you have generated this pool. Now what you do is, that these are those 4 years, sorry. You invest 30 lakhs in each of these years. Your growth is, this is income that is generated is 4 lakhs, 12 lakhs, 23 lakhs and 36 lakhs each. And you're not withdrawing any single money, any single rupee from that. So your pool is growing. Now from the 5th year, you will not leave your jobs. Now there's one strategy, again, as Kinney sir was also saying, and a lot of other speakers have spoken before that. Don't lose your regular income. Don't sacrifice that. So in these first 4 years, what you would do is do your market research, do your planning, do your ideation, your strategy building, okay? Do that thing. Build up an MVP. And why the 5 founders that I have taken? Why 5? Why not 3? Why not 2? You need 5. There are 5 very important key areas of business that you must understand. So it is not just about you being a technologist, you think about technology. It's not like that. Startup is a business. And business needs a lot of things. So one is technology, of course. One is the marketing. If you can't market it to people, if you can't sell it, even a good product is useless, right? So you need marketing team. You need a finance guy who knows, understands about the numbers. So you need, and one domain expert. So 5 people is what you need in a team. And why founders? You would say, okay, let's hire them. But if you hire them, then as Kinney sir was saying, you have to pay them. That becomes a difficult thing. How will you bring the money to pay? If you pay, you are losing out of your pocket. Being founders, they are the best people and they come for free because it's their company. They have the equity. So all these 5 people are not drawing any salary. They are working for free, part-time, apart from their corporate jobs. And in the 5th year, they continue to do so. Okay? But now, they start building their team as well. They start spending money also on marketing, maybe team, something else. So this year, they withdraw 45 lakh rupees from this fund and spend it on their startup. Okay? But at the same time, they also invest the next 30 lakhs. And this goes on up till 8 years. So every year, they're investing 30 lakhs. And now they're withdrawing 45 lakhs, 59 lakhs, 66 lakhs, and 80 lakhs. And this money that they withdraw goes to fund their startup. Now let's see what happens at the end of the 8th year. Have they lost their money? Irrespective of whether the startup succeeds or not. I'm telling you the investment strategy. It has nothing to do with success of your startup. If your startup succeeds, you make 100x, 200x, 500x. Even if it doesn't succeed, let's take the worst case scenario, if your startup fails, what will you end up with? But before that, I'll also tell you, what is the withdrawal strategy? How much money to withdraw? That's also very crucial. So in this example, I've taken 125% of the growth in the previous year. So this 45 is 125% of 36. Okay? If you do this, you cannot withdraw the whole money, okay? Then you lose the compounding effect. So as the saying goes, you cannot kill the golden goose. Let it lay the eggs. We'll play on the eggs. Okay? So total you have invested 2.4 crores. Your growth is 2.95 CR. Out of this 2.95, you have withdrawn 2.5. So your principal amount that you have invested stays intact. The 2.4 stays intact. plus another 45 lakhs of income also remains in the fund. Now suppose the startup fails, and I think 4 years is enough to know that your startup is not working, and they decide to shut down the business, they can still withdraw their original investment. Everyone gets back their capital plus some part of the profits as well. So who has funded the startup then? Who has funded the startup? The income that you have generated has funded your startup, not your capital. Now tell me, people say investing in startup is a big risk. What we have done is taken out the risk. There is no risk. You have not lost a single rupee of your capital. So let's understand the logic behind it, how this happens. So these are the first 4 years. These are the next 4 years. You are again investing the money. So this is your original investment. This is the income, the compounding effect that has generated. Okay. Now, if suppose you don't start the startup, then what will happen? In the 8th year, you will have 6.7 crores. Now just imagine, your investment is what? 2.4 crores in 8 years. That 2.8 has gone up to 6.7 CR. You can distribute that money, be happy. But you don't do that. You decide to start your own startup, right? So your contribution is 2.5 crores, 2.4, and your total capital value now, the fund value is 6.7. But you decide to start your own startup. So this is the amount that you are withdrawing. Okay? In total, that amount you have withdrawn is 2.5 CR. But now you can understand the point, the logic. Which amount you are withdrawing? It is not the original amount that you have invested. What you are withdrawing is from the income that you have generated. Right? So even after withdrawing that 2.5 CR, okay, so what is that black then? Now you can see that was income that you could have generated, but one of the bad effects of withdrawal is that you lose income on income. So the amount you withdraw, the income on income is lost on that. So the black that you will see is the loss, or we can say the notional loss that you have suffered. And in finance, the notional loss is a very important thing. Okay? And that loss of compounding is 1.35 CR. So you have lost that money because you have withdrawn this money to fund your startup. Fine, no problem with that. You are still left with a growth of 45 lakhs. So that income is still there in the fund. Now you decide. If your startup is successful, continue. So by the end of the 4th year, your bootstrapping should actually end. Then you should get funding. The fund that you get, you raise, will then take the startup further. You cannot invest your own money. So if you've reached that level, you can take angel funding, you can take VC funding and run your startup. If not, you can still shut down, take back your money. Now if we do a comparative analysis of the first case scenario and the second case scenario. First case where after 4 years you just invest your money in startup and do something. And in the second case, where you create a pool of investment, create income on income and then invest that income into your startup. What's going to happen? So in the first case scenario, if you lose everything, if your startup fails, you have lost 2.5 CR. Even if it succeeds, you have still lost 2.4 CR from your pocket. The money has gone out, cash flow we were talking about. So there's a cash outflow of 2.4 CR. Okay? In the second case, you have invested 2.4, you have generated an income of 2.85, so you are still left with 2.85 in your hands. If take both the cases, startup is successful, you still do have 2.85 apart from the success of the startup. If it goes wrong, you still have 2.85. So what is the difference between the two? The difference is 5.25 CR in this example. So the advantage of going for the second option is 5.25 CR. Now, let's go back and understand another strategy. So this is again back. So the point was that if I run my startup and I withdraw 2.5 CR, I will be losing 1.35, right? On compounding. Let's extrapolate this for another 20, 30 years down the line. What impact this will have 20 years down the line or 30 years down the line, let's see. So these are the first 8 years, you should have 6.7, but as we see, you have withdrawn 2.5, so you are left with only 2.85. At the end of the 30th year, if you would not have withdrawn the money for doing your startup, now why I'm telling you, I'll tell you later on, okay? If you would not have done your startup, your fund of 6.7 crores would have grown to 908 crores. With no further investments, you have invested only 6 lakhs each for 8 years. That's it. Can you invest 3 lakhs rupees an annum for 8 years? Anyone can invest, right? It's a simple figure. At the 30th year, that amount would have grown to 908 CR. And if we do it for another 10 years, that's by the end of the 40th year, you know how much that amount would be? 8,452 crores. So now what is the question that I'm going to ask you? Is it worth doing your startup? Right? Now just imagine, because of withdrawal of this amount here, 2.5 CR, your loss has been accumulated to 4,860 CR. These are the two figures that you need to understand. So there's another decision-making point. Should you do your startup? Or should you be happy with your corporate life? If you don't love your corporate life, you can leave your corporate life, but do investments, as I tell you, and you will generate this money over the years. That's the basic difference between, I am not classifying any people like middle class and upper class or something, but the normal people and the wealthy people. You have to understand how to create wealth. And compounding is one of the biggest way of creating wealth. So do your startup. It's very important to have your passion and, go after the passion. But at least don't put your pocket money into your startup. Okay? Still, you can see this 45 lakhs that was left here will still grow. So this is total amount that you have, 2.85 CR here. If you keep it like that for another few years, by the end of the 40th year, that money will also grow into 3,592 crores. So you have pursued your startup dream. Even if it fails, still fine. Keep that money invested. That will also grow. So guys, and you see the X factor. We say this, why people invest in startup? Because you get 100x valuation, you get 50x valuation, correct? So even without a startup, you can generate this X factor, the multiplying factor, which is very crucial to understand. So when you sit down and you want to decide whether you want to invest in startup or not, look at these figures. What will happen if I do invest? What will happen if I don't invest? I continue my investments in the maybe a small cap mutual fund. Relax, enjoy life, go on vacations every month, and you can live your whole life, happily. But then also decide that if you're investing in startup, what kind of returns you should get to at least compensate this loss. So when we say that, okay, I am investing 5 crores in my startup, even if I get 5 crores, that's fine. No. See the compounding effect. So you should recover 4,860 crores to break even. So the lessons are that goal-specific investment strategy is very, very crucial. You might have heard a lot of these financial webinars and seminars and all. So people talk about savings, okay? People talk about, okay, if I have 1 lakh rupees of salary, I'll first incur all the expenses, then I'll pay my EMIs, and after paying the EMIs, then I will save something, I'll put in the mutual funds or somewhere. That's a very wrong strategy. I've got a different strategy. Never pay any EMIs from your pocket. Invest the whole amount of money into your investment strategy, let it compound, and then you can withdraw the money out of the compounding income and use it throughout your life. So I have case studies where you can buy best of the best motor cars, Mercedes-Benz and Audis free throughout your life. Every 10 years you buy an Audi free. Every 10 years you buy a bungalow free. Every few years you invest in your startup free. Follow the goal-specific investment strategy. Just give a few years. That's the only sacrifice that you have to make. So if you're thinking of buying a house, if you're thinking of buying a car, if you're thinking of investing in your startup, give me 4 years. And the rest, 30 years, 40 years, you will get tremendous growth, tremendous value appreciation. So the benefits of goal-specific strategy are it protects your capital. Goal planning and accomplishment, you are able to plan your goal and accomplish them. No diversion of funds, full benefit of compounding. So that's the topic for the day. And so there are many other strategies that you can employ. Another strategy, but of course, today's topic was bootstrapping. Otherwise, there are a lot of hedging strategies, like you start your own startup as well as invest in other startups at the same time. Not put all your money in your own startup. Put some money in your startup, some money in other startups. So even if something fails, something will succeed, and you will at least get back your capital